forexbrokers.net, and we continue with the second video dedicated to Japanese candlesticks patterns. So far we've discussed what is a candlestick and treated a bit the complexity of interpreting the doji candlestick. And now I would like to cover a few examples that you find in the article. And the first one is a pattern that is called bullish engulfing. It is worth mentioning that most of the reversal patterns, actually all of them, coming with the Japanese candlesticks, they have a counterparty. For instance, a bullish engulfing, or the rules for a bullish engulfing, of course, that they apply for a bearish engulfing as well, in the sense that all those rules apply differently to find a short trade instead of a long trade. The first thing on any reversal pattern is to have a bearish trend in the case that the reversal pattern is bullish, or to have a bullish trend in the case that the reversal pattern is bearish. So for a bullish engulfing, normally you gotta have a bearish trend. The pattern consists of two candlesticks, one candlestick in the direction of the underlying trend, and then another candlestick that comes and engulfs the real body of the previous candlestick. So two opposite candlesticks, with the second one stronger than the first one. That's the pattern. The minimum distance for the price to reverse is the entire body of the previous candlestick, but, and here is a catch, many traders make the confusion here, it should not engulf the upper shadow as well. Part of it, yes, but not all of it. Sometimes the market makes a very strong move, and that kind of a move is enough to, I don't know, for this candlestick to close somewhere around here, which is invalidating the pattern because it engulfs also the upper shadow of this candlestick. That's not possible. So what do we have? A bearish candlestick and then a bullish candlestick, the close here. Never ever, when using reversal patterns like the Japanese ones, you never ever go on the long side or on the short side right where the candlestick ended here. Wait for a pullback. It's only normal after a reversal pattern to have or to see a pullback. Why? After all, this is a bearish trend. The bears won't give up that easy. Plus, a pullback gives you a better entry for risk-reward ratio. And sometimes the patterns simply do not work. Any pattern should be treated with maximum responsibility and with a very strong money management system. A money management system is built out of risk-reward ratios, which are the pillar of any good money management system. Ideally, for the FX market, you should look for every trade to have a risk-reward ratio of 1 to 2. Reversal patterns using Japanese candlesticks, they give us better risk-reward ratios when compared with other patterns. In this case, 1 to 3 risk-reward ratio comes naturally. The entry place is 38.2, 50%, when compared to the entire dimension or the entire length of the pattern. What's the entire length of the pattern? You should look at the two elements of the pattern, the bearish and the bullish candlestick, and then take the upper and the lower part and measure it. We see that the highest point and the lowest point belong to the first candlestick here, and then the second candlestick simply is shorter than the first one, but enough for the real body to engulf the real body of the previous candlestick. And we wait for a pullback. This is the pullback, this is the price. The market comes into 38.250. That's the entry. Always have a stop loss at the bottom, because sometimes the bearish pressure is so strong that the market goes and make a new high. That's all right, it takes the stop loss. But if not, this is why we should stay, or traders stay, for 1 to 3 risk reward ratio. So 1, 2, 3 risk reward ratio based on this risk. So this is the bullish engulfing. Another pattern explained here with still with the 1 to 3 risk reward ratio is the piercing pattern, which is similar with the bullish engulfing. It's a bullish pattern, but the only difference between the two is that the real body of the second candlestick here doesn't totally engulf this the body of the previous candlestick here, but the minimum distance to travel is 50%. So if it recovers 50% of that real body and closes between 50 and 100, then that's a piercing pattern. The way to trade it is similar. Measure the distance between the highest point and the lowest point here using a Fibonacci ratio. Find out the 38.2 50%, this highlighted area, and then simply go on the long side. In this case, we see that this happened on a Friday, and then the opening on Sunday, because it is the only time we have a gap between the opening and closing prices here. So the market opened with a bit of a gap from, what's this? This is the Great Britain pound US dollar, from 1.28 all the way to 1.2775. A bit of a gap, enough to fill the order, but the lows, they did hold, and therefore 1 to 3 risk reward ratio. The market consolidated for more than 14 candlesticks, but eventually it picked up and moved all the way to the risk reward ratio. As you can see, the price exceeded by far the 1 to 3 risk reward ratio. Aggressive traders sometimes move the stop loss to break even by the time that the price reaches 1 to 1, and then by the time that the market advances with another part of that reward, then traders trail the stop, locking in further profits, and this way you may end up making even more than 1 to 3 risk reward ratio. The last example that I will show you today is the so-called morning star. By the way, on the piercing pattern, the opposite of the piercing pattern, the bearish pattern is called a dark cloud cover. The conditions are similar, of course. And on the morning star, the opposite of the morning star is called an evening star. This time the pattern has 3 candlesticks. One in the direction of the underlying trend, which is a bearish trend. And then this is a strong candlestick. Then a very small candlestick, which may have either a bullish real body, in this case with the green color, highlighted with the green color, or a bearish real body, doesn't matter. And then the second candlestick comes and retraces more than 50% of the third candlestick. So retraces more than 50% of this first candle. And therefore this group of 3 is called a morning star, a bullish pattern. To trade it, measure the highest point of the pattern and the lowest one. Find 38.250 as the entry level. In this case, the market moved to the upside. It didn't reach the initial risk reward ratio, the 1 to 3 risk reward ratio, so the trade is still valid. If it would have reached 1 to 3, then the pattern should be skipped because the scenario already played out. But the disciplined trader simply waited for the pullback, which came. It gave a very nice risk and reward ratio, and then by the time that the entry came in the next 1, 2, 3, 4, 5, 6 candlesticks times 1 week, so in 6 weeks, because this is the weekly chart, the market came and reached the 1 to 3 target. The opposite of a morning star is the evening star. Obviously, it is a bearish pattern that forms at the end of bullish trends. Thank you for being here, and bye-bye.